A Tuesday morning in mid-January, you're checking your portfolio before the first coffee cools. The COMEX silver spread, the gap between bid and ask, just blew significantly wider than recent historical ranges. Not during a crash, not during a headline crisis, during what the media will later call routine profit-taking. Within the same hour, multiple delivery notices hit registered vaults. Multiple documented broker calls landed on long-position retail holders in a concentrated window. Same firms, same script. Liquidity conditions require immediate review. No margin breach, no actual risk trigger, just pressure. The surface story, normal volatility, the incentive reality, month-end index rebalance colliding with February's delivery window. Perfect timing for institutions that need you gone. You're not watching a sell-off, you're watching coordinated exit extraction. By the time New York opened that Tuesday, the bid-ask spread on front-month COMEX silver futures had already gapped to levels unseen since the 2016 Brexit panic. But there was no Brexit, no Fed surprise, no geopolitical shock, just a spread that shouldn't exist under normal liquidity conditions. And yet there it was, flashing red across every dealer screen. COMEX registered inventory had dropped sharply over several days, according to vault reports published by the exchange. Not a sell-off, a withdrawal. Physical metal leaving the system exactly when passive ETF rebalance windows opened for the week. You refresh your screen, the number keeps falling. No one's explaining why. The headlines stay quiet. While the media sleeps, vault data screams, this isn't volatility, it's a signal. And someone needed you to miss it. The pattern begins not with chaos, but with silence. The kind of silence that precedes coordinated action. Registered vaults, the warehouses approved by COMEX to hold deliverable silver, don't empty by accident. Every withdrawal is documented, every movement logged. The data sits there, public but ignored, while surface narratives talk about technical levels and momentum indicators. But vault data doesn't lie about one thing: physical demand. When metal leaves the registered category, it signals someone converting paper claims to actual bars. And when that happens during a rebalance window, the timing stops being coincidence and starts being strategy. Between 9:30 and 11 a.m. Eastern, the calls started. Not one firm, multiple firms. Not random outreach, coordinated scripts. Retail holders with long silver positions, people who'd been in for months, some for years, got nearly identical phrases delivered with identical urgency. Unprecedented conditions. Risk management review. We recommend you consider your exposure. No actual margin breach reported, no compliance trigger, just pressure dressed as prudence. The institutional motive wasn't complicated. Prime broker risk desks were carrying short silver derivatives into February delivery, and they needed client exits to cover short gamma exposure before the calendar turned hostile. You're the liquidity. They need you to move. The viewer trap is elegant. Sell now, before it gets worse. But what's getting worse? The February 28 options expiry cluster sits 3 weeks out. The early March index reconstitution window follows shortly after. The deadlines aren't coincidence. They're constraint. And constraint creates desperation. Here's what makes the call wave so revealing. The scripts don't vary by account size, by position duration, by client sophistication. The same language hits everyone. That's not personalized risk management, that's mass messaging, and mass messaging during a known calendar pressure point suggests someone needs volume, not prudence. The urgency isn't about your portfolio health, it's about their book balance. When 3 firms use the same terminology in the same morning window, you're not hearing independent analysis. You're hearing aligned incentives speaking in unison. The beauty of the trap is its reasonableness. Risk management review sounds responsible. Consider your exposure sounds prudent, but strip away the professional language and you're left with a simple pressure tactic. Move now or regret it later. The emotional lever is fear of being last. The functional purpose is generating liquidity during a window when liquidity is scarce and valuable. Your exit becomes their cover. By midday, the official story began to solidify. Financial media framed the move as profit-taking after a strong Q4 rally. Technical analysts pointed to resistance levels and overbought indicators. Reasonable, plausible. Except none of them mentioned the delivery calendar. None referenced rebalance mechanics. None cited vault data. The index committee published a routine methodology reminder days earlier, buried in fine print, as always. The real constraint, passive funds holding physical-backed silver shares, must sell to reweight when index composition shifts. It's not opinion, it's automation. Rules-based selling triggered by committee decisions made weeks earlier. Institutional coordination isn't conspiracy when the calendar does the work. The timing precision suggests someone read the same rulebook and positioned accordingly. You start questioning the surface explanation. The math doesn't add up. Silver fundamentals haven't changed. But the calendar did, and calendars don't lie. This is where surface narratives and structural realities diverge. Profit-taking implies choice, traders deciding the rally has run its course, but when passive funds hit rebalance triggers, there's no choice. The algorithm sells. The index methodology dictates the action. Fund managers don't debate whether silver is overvalued. They execute the reweight. And everyone who reads the methodology documents knows it's coming. The committee doesn't hide the rules. They publish them. The exploitation happens when that public knowledge becomes a private trading edge, when those who see the calendar collision position themselves to profit from the forced flows they know are approaching. What the headlines omit is the mechanical pressure building beneath the surface. Delivery windows, rebalance mandates, and options expiry don't move independently. They cluster. And when they cluster, liquidity fragments. Bid-ask spreads widen not because of fundamental uncertainty, but because market makers know they're operating in a constrained window where price discovery gets distorted. The spread blowout isn't random. It's rational from the perspective of those managing short-term risk in a calendar-compressed environment. So who benefits when you sell under pressure? Prime broker risk desks carrying short silver derivatives into a delivery month they'd rather avoid. Bullion banks positioned short ahead of known index exit flows. Algorithmic funds front-running the expected passive selling, scalping the spread on both sides. Every exit you make is liquidity they need. The incentive map is clean, broker commissions on the trade, risk reduction before delivery, algorithmic profits on volatility they helped create. Retail long holders aren't the enemy. They're the solution. The psychological layer is what makes it work. Urgency framing hides liquidity extraction motive. You're told it's about protecting yourself. The truth, they're protecting their book, and your fear is the grease that makes the machine run. They didn't need you to panic. They needed you to move. Follow the incentive structure, not the surface explanation. Prime brokers carry client positions, but also manage their own risk. When they're short into delivery and the calendar tightens, they need offsets. Your long position becomes their hedge if they can convince you to sell it. The pressure isn't about your risk. It's about theirs. The urgency isn't about market conditions deteriorating. It's about calendar conditions tightening. And the script is designed to conflate the two, making you think the urgency is fundamental when it's actually operational. Bullion banks face similar pressure, but from a different angle. They're often short physical silver through derivative structures, hedging, mining forward sales, or ETF creation units. When index rebalances force passive selling, they can cover shorts at better prices, but only if the selling actually happens. Retail exits accelerate the forced flows, amplifying the price pressure that benefits their positioning. The incentive to encourage exits is direct and documentable through position disclosures, though those disclosures often lag the actual trading by weeks. Algorithmic funds add the third layer. They don't need the exits for risk management. They need them for volatility. Widening spreads, accelerating volume, and directional momentum create the conditions where high-frequency strategies extract profit from the chaos. Your emotional decision to sell under pressure becomes their statistical edge, replicated across thousands of retail accounts making similar choices in similar windows. By the week of January 20th, the fear machine was fully operational. Coordinated messaging across platforms, same keywords, same timing, same tone. Overheated. Unsustainable. Profit-taking recommended. The language wasn't analytical, it was psychological, and it was everywhere. No corresponding institutional disclosure of short positions, no transparency on who was selling, just the certainty that everyone was. The historical parallel to 2021 is unavoidable. During that squeeze, retail got the same script: exit now, protect profits, don't be the last one holding. The messaging worked then. Why wouldn't it work again? Script analysis reveals the gap. Psychological manipulation packaged as market analysis. When multiple major outlets publish bearish silver pieces in close succession with overlapping talking points, you're not watching independent journalism. You're watching aligned incentives. The viewer begins to recognize the pressure campaign for what it is, not organic advice, but orchestrated urgency. Fear was the product, you were the market. The 2021 silver squeeze serves as the emotional anchor for the current pressure campaign. If you held through that event, you remember the volatility, the Reddit-driven hype, the rapid collapse. The institutional script exploits that memory. Don't get caught again. This time is no different. The recency bias is weaponized. Your lived experience becomes the psychological lever that makes the current urgency feel validated. But the calendar dynamics are different. The delivery constraints are different. The index mechanics are different. What's the same is the script. Watch the language pattern. Overheated suggests unsustainable momentum, but it's a subjective framing with no precise definition. Profit-taking recommended sounds like strategic advice, but it's functionally a sell signal without analytical foundation. When this language repeats across platforms within tight time frames, the synchronization reveals coordination, not of conspiracy, but of aligned incentives among brokers, analysts, and media outlets who all benefit from increased trading volume and directional conviction. The absence of corresponding institutional disclosure is the silent tell. If major short positions were being closed, that would appear in regulatory filings eventually. If systematic selling were happening, order flow data would show it. But the urgency to exit isn't matched by transparency about who's buying. The asymmetry suggests the pressure is designed to create liquidity where it's currently scarce, not to reflect liquidity that's already abundant. Now layer the deadlines. February 28th, last notice day for COMEX silver delivery. Early March, scheduled index rebalance period. Late February, options expiry cluster with substantial open interest in play. 3 constraints. 1 compressed window. The calendar collision creates a short-term liquidity crisis for any institution positioned short into delivery. Retail exits provide the cover they need to reposition without triggering a squeeze. The market mechanism, delivery windows, rebalance rules, option settlement, becomes the pressure weapon, not because the rules are broken, but because they're known. And when you know the rules, you can position around them. The urgency isn't about your portfolio, it's about their calendar. 3 deadlines, 1 desperate week, perfect timing. COMEX. Silver delivery mechanics are public information, published in contract specifications, available to anyone. Last notice day is the final day a long position holder can demand physical delivery for that contract month. After that, positions must roll forward or settle in cash. Bullion banks and dealers manage this process daily, but when open interest is elevated and registered inventory is tight, the mechanical pressure intensifies. They need long holders to roll or exit before delivery demand overwhelms available supply. Index rebalances operate on published schedules. Committees announce methodology changes, effective dates, and weight adjustments weeks in advance. Passive funds tracking those indexes must execute the trades to match the new composition. The flows are predictable, directionally certain, and often substantial in size. Front-running those flows, positioning short before the forced selling hits, is a well-documented strategy that sits in the gray zone between legal trading and manipulative practice, depending on execution and intent. Options expiry adds the 3rd mechanical constraint. When large open interest clusters at specific strike prices near expiry, dealers managing those options face gamma exposure, risk that accelerates as expiry approaches. Managing that exposure often involves hedging in the underlying futures, which can amplify price moves and spread volatility. The expiry itself is predictable. The behavior it triggers is mechanical, and anyone positioned to benefit from that mechanical behavior has an incentive to ensure it unfolds as expected. Here's the mechanism they're not explaining. Passive ETF methodology requires funds to sell physical-backed silver shares when index weight drops below a threshold. It's automatic, no discretion, no opinion, just rules. Estimated impacts vary by fund size and index methodology, but the direction is certain, selling pressure from forced rebalancing. That's not oversupply, that's automation. And institutions know it's coming because the index committee published the methodology months ago, so they pre-position short, front-running the forced selling they know is inevitable. You, the viewer, learn the lesson. Technical selling does not equal fundamental weakness. It's just a calendar event, dressed as market sentiment. The spread blowout makes your exit expensive, and that expense is profit for the short position traders who saw this coming. The selling wasn't opinion, it was automation. Passive investing dominance has transformed how markets process information. When a significant percentage of assets track indexes mechanically, the index methodology becomes the trading signal. Committee decisions about sector weights, constituent additions, and rebalancing thresholds ripple through markets not as information about fundamental value but as mechanical instructions to buy or sell. The predictability creates opportunity, and that opportunity is most valuable when retail participants don't recognize the mechanical nature of the flows they're watching. Physical-backed ETFs add complexity because they hold actual metal, not just futures contracts. When shares are redeemed, metal must be sold or removed from backing. When index weights drop, redemptions accelerate. The metal hits the market, registered inventory shifts, and vault data reflects the movement. It's all public, all documented, all predictable, for those watching the right data sources. For those watching price and headlines, it looks like selling pressure from deteriorating fundamentals. The spread blowout during these windows isn't market makers panicking. It's market makers protecting themselves from being the liquidity provider in a mechanically distorted environment. They widen spreads because they know forced flows are coming and they don't want to be caught on the wrong side. The wider spread is the tax you pay for trading during calendar compression, and that tax is profit for those who positioned early and those who provide the distorted liquidity. Now add the delivery math. COMEX registered vault inventory stood at approximately 62 million ounces, according to exchange data. Open interest in February contracts reportedly exceeded 41,000, representing potential claims on over 205 million ounces. The delivery ratio isn't sustainable if everyone stands for delivery. They won't. Most contracts roll or settle in cash. But the optics create pressure. Bullion banks need retail exits to avoid the nightmare scenario where delivery demand outstrips registered supply. So broker scripts escalate urgency in the week before first notice day. The timing isn't coincidence. It's forensics. Market forensics. When the motive aligns with the calendar, follow the incentive. They called it risk management. The calendar called it desperation. The mathematics of delivery are simple but powerful. Each COMEX silver contract represents 5,000 ounces. Multiply open interest by contract size, and you get the theoretical maximum delivery demand. Compare that to registered inventory, and you get the coverage ratio. When that ratio tightens, the system stress increases. Not because delivery will actually happen at that scale, it almost never does, but because the possibility creates operational risk for dealers managing the delivery process. Vault categories matter. Registered inventory is metal specifically allocated for delivery against COMEX contracts. Eligible inventory is metal stored in approved vaults but not currently allocated for delivery. Metal can move between categories, but the process takes time and depends on ownership decisions. When registered inventory drops while open interest stays elevated, the coverage ratio tightens mechanically. And that tightening shows up in spreads, in delivery premia, and in the urgency of broker messaging to long holders. The week before first notice day is when delivery intentions crystallize. Long holders must decide, take delivery, roll to a later month, or close the position. Dealers managing short exposure need to know how much physical delivery they'll face. Uncertainty during this window is expensive. Certainty, even if it means slightly worse pricing, is valuable. Retail exits provide that certainty. The broker calls aren't about protecting you. They're about protecting the clearinghouse, the dealer network, and the mechanical functioning of the delivery process. During the third week of January, broker call volume reportedly increased substantially across online forums and social platforms. Anecdotal, yes, but patterns emerge. Spread manipulation became visible in real time. Bids pulled during low-volume windows. Asks lifted to widen the gap. Algorithmic trading amplified downward pressure during the known passive rebalance window, front-running the forced selling everyone anticipated. Media synchronization reached peak visibility when multiple major outlets published bearish silver analysis in close succession. Not collaboration, just aligned incentives and shared sources. The coordination isn't conspiracy. It's precision. Manufactured urgency meets real deadline pressure, and the viewer sees it clearly now. The pattern isn't hidden. It's documented. It wasn't a sell-off. It was a script. Anecdotal evidence from forums and social platforms doesn't constitute proof, but it does establish pattern. When dozens of users across unrelated platforms report receiving similar broker calls with similar language and similar timeframes, the pattern suggests coordination at the institutional level, not individual rogue brokers, but systematic messaging aligned with calendar pressure. The scripts don't leak by accident. They leak because the volume is high enough that someone always talks. Spread manipulation during low-volume windows is a documented phenomenon, though proving intent is difficult. Market makers pull bids and lift offers when they don't want to provide liquidity, either because they see adverse information or because they're managing their own risk in a constrained environment. The effect is the same. Spreads widen, execution costs increase, and holders facing pressure to exit pay more to do so. That cost is profit for whoever's on the other side. Algorithmic amplification is mechanical, not conspiratorial. Algorithms detect momentum, volume patterns, and volatility spikes. They trade in the direction of those signals, amplifying the initial move. When forced selling from passive rebalances hits the market, algorithms detect the directional flow and add to it. The selling pressure isn't just the passive funds, it's the passive funds plus every algorithm programmed to detect and trade with that flow. The cascade is predictable, and predictability is tradable. Media synchronization is harder to attribute but easier to observe. When multiple outlets publish similar analysis with similar conclusions in tight timeframes, the explanation is usually shared sources, research notes from major banks, analyst reports distributed to media contacts, or press releases from industry groups. The content isn't coordinated in smoke-filled rooms. It's coordinated through the normal distribution channels of financial analysis. But the effect is the same, a unified narrative that reinforces the urgency to exit. This is your decision point. Sell under pressure, validate the script, become the exit liquidity they needed, or hold through the manipulation and follow the incentive map instead. The emotional contrast is brutal. Broker urgency on one side, delivery calendar reality on the other. The false premise whispered everywhere, everyone's selling. But Vault data shows inventory outflow, not inflow. Someone's buying. The institutional script exploits recency bias from the 2021 squeeze collapse. You remember how that felt. They're counting on it. This is the pattern recognition moment. Fear language equals liquidity extraction tool. The weapon wasn't price, it was certainty, and you refuse to hand it over. The decision isn't about predicting price direction. It's about recognizing behavioral pressure for what it is, a tool to generate liquidity during a constrained window. If you sell now, you validate the script and provide the exit flow institutions need to manage their calendar risk. If you hold, you refuse to be the solution to someone else's operational problem. Neither choice is right or wrong, but only one is made with full awareness of the incentive structure driving the pressure. Vault data provides the counter-narrative. If everyone were selling, registered inventory would be rising, not falling. If physical demand were collapsing, eligible inventory would be building, not stable or declining. The data contradicts the fear message. Someone is buying the metal being withdrawn, someone is taking the other side. The pressure to sell is unidirectional, but the market activity is bidirectional. That asymmetry is the tell. The 2021 parallel is weaponized memory. You remember the hype, the collapse, the regret of holding too long? The current script activates that memory to create urgency in a structurally different environment. The squeeze dynamics aren't the same, the delivery mechanics aren't the same, the index flows aren't the same, but the emotional resonance is identical. And emotional resonance is what makes behavioral pressure effective. Pattern recognition is the defense. Once you see the script for what it is, a pressure tactic aligned with calendar constraints, the urgency loses its power. You're no longer reacting to fear. You're analyzing incentives. And analyzing incentives allows you to make decisions based on your own timeline, your own risk tolerance, your own strategic view, not someone else's operational need dressed as prudent advice. By February 1st, the spread normalized. Post-rebalance completion, liquidity returned as if nothing had happened. The March delivery period proceeded without crisis, without shortage, without the systemic event the urgency implied. Retail exits provided institutional cover, exactly as the incentive structure predicted. No fundamental collapse, no vindication for the fear narrative, just a calendar that closed and a market that moved on. Viewer validation arrived quietly. Calm analysis beats manufactured urgency every time. The market returned to equilibrium once the institutional need was satisfied. The crisis ended when the calendar did. Spread normalization after the rebalance window is the empirical validation. If the fundamental case for silver had deteriorated, spreads would have stayed wide. If systemic risk had been real, delivery strain would have persisted. Instead, liquidity returned, spreads tightened, and market function resumed normal patterns. The urgency was calendar-driven, not fundamental, and calendar-driven urgency evaporates once the calendar pressure lifts. March delivery proceeded without incident because the system functioned as designed. Registered inventory handled the actual delivery volume. Contracts rolled forward. Cash settlements processed smoothly. The nightmare scenario used to justify the urgency never materialized because it was never likely, just operationally possible in a worst-case scenario that institutional risk managers are paid to avoid. Retail exits helped them avoid it, but avoiding it didn't validate the fear. It validated the manipulation. The lack of fundamental vindication is the final piece. Silver fundamentals didn't collapse in late February, supply didn't surge, demand didn't crater, industrial outlook didn't deteriorate. The price move was mechanical, driven by forced flows and calendar constraints, not by information about future value. And when mechanical pressures lifted, price stabilized and even recovered. Those who sold under pressure sold at the worst possible time, exactly when institutional buyers were positioned to absorb the flow at favorable prices. This is the lesson. Manufactured urgency during calendar-constrained windows is a documented pattern. It repeats because it works. Retail exits provide institutional cover during periods when liquidity is scarce and operationally valuable. The fear narrative creates the pressure, the calendar creates the deadline, and the combination extracts liquidity from those who don't see the pattern. Now you have the tools. Follow delivery calendars, map incentives, track vault data, question urgency, verify premises, decode scripts. Institutional tactics remain constant because they work until you learn to spot the signals. The emotional shift is complete. From anxiety to forensic calm, pressure campaigns become information, not commands. You're no longer the victim. You're the detective. The pattern repeats. Now you see it. Delivery calendars are public. COMEX publishes them. Index committees publish rebalance schedules. Options expiry dates are known months in advance. The information is free and accessible. The edge isn't in having the information, it's in recognizing how that information creates mechanical pressure that others will exploit. When delivery windows, rebalance dates, and options expiry cluster, expect liquidity pressure. Expect spread volatility. Expect coordinated messaging. The pattern is predictable once you know what to look for. Incentive mapping is the analytical framework. When broker urgency spikes, ask, who benefits from my exit? When media narratives align, ask, what calendar constraint is approaching? When vault data contradicts the selling narrative, ask, where's the metal going? The answers reveal the hidden structure beneath surface volatility, and understanding that structure transforms fear into information. Vault data is freely available through exchange websites, updated daily. Registered inventory, eligible inventory, and daily movement reports provide the empirical foundation for analysing delivery dynamics. When messaging says everyone's selling, but vault data shows outflows from registered categories, the data exposes the narrative gap. Trust data over urgency. Script decoding is pattern recognition applied to language. When identical phrases appear across firms, the messaging is systematic, not individualized. When urgency escalates before known deadlines, the calendar is the driver, not your personal risk. When fear language replaces analytical language, the goal is behavioral pressure, not informed advice. Recognizing the script allows you to separate signal from manipulation. The emotional evolution from anxiety to calm analysis is the ultimate defense against behavioral pressure. Anxiety makes you reactive. Calm makes you deliberate. Anxiety privileges urgency. Calm privileges accuracy. Anxiety responds to scripts. Calm decodes them. The shift isn't about eliminating emotion. It's about channeling it into pattern recognition rather than panic. The surveillance continues. June delivery window, September index review. You're equipped now to recognize coordination patterns when they emerge. No predictions, only preparation. Empowerment through pattern literacy, not trading advice. The moral ambiguity remains. Institutions executing legal strategies within known market rules. Is it manipulation or market function? That's for you to decide. What's certain, calm analysis is the counter-weapon. The call will come again. Now you know why. Future delivery windows follow the same mechanical patterns. June, July, September, December. Each month brings the same calendar structure, the same delivery mechanics, the same potential for calendar-driven pressure. The tactics don't change because the incentives don't change. What changes is your ability to recognize them before they extract liquidity from you. Index reviews operate on published schedules. Committees meet quarterly or annually, announce changes, and set effective dates. Passive funds execute the resulting trades in predictable windows. The flows are knowable in advance for anyone tracking methodology documents, and those flows create the same mechanical pressure every cycle. Preparation means marking those dates, watching vault data during approach windows, and maintaining analytical skepticism when urgency narratives emerge. Pattern literacy is the empowerment. You're not predicting whether silver will rise or fall. You're recognizing when pressure campaigns align with calendar constraints, when messaging is designed to extract liquidity rather than inform analysis, and when your emotional state is being manipulated to serve someone else's operational need. That recognition doesn't tell you what to trade. It tells you when you're being pressured to trade on someone else's timeline. The moral ambiguity is real and unresolved. Are institutions manipulating markets or managing legitimate operational risks? Are broker calls predatory or prudent? Is media coordination conspiracy or coincidence of aligned incentives? The answer probably lies somewhere in the middle. Legal strategies executed within permissible bounds, but designed to extract value from information and calendar asymmetries. Whether that constitutes manipulation or just sophisticated market function is a judgment call. What's not ambiguous? The pressure is real, the calendar constraints are real, and your exits provide real value to those applying the pressure. Calm analysis is the counter-weapon because it breaks the behavioral chain. The pressure campaign depends on urgency triggering action. Calm analysis introduces delay, verification, and incentive mapping into the decision process. That delay disrupts the extraction mechanism. Your refusal to act on urgency alone denies institutions the liquidity they need exactly when they need it most, and that denial shifts power from the script writer to the script reader. The call will come again. Different month, different deadline, same script, same incentive structure, same calendar mechanics, but now you recognize it. The urgency arrives and you don't react. You analyze, you check the calendar, you review vault data, you map the incentives, you decode the script, and you decide whether to act on your timeline or theirs. That choice is power. 6 months later, the phone rings. Same broker, different deadline, but this time you hear the script before the first sentence ends. The pattern persists, the power shifted.